Welcome to this next edition of the Multifamily Investor Nation webinar series, where we come to you every single week with a free weekly webinar surrounding multifamily investing. Today, the topic at hand is actually going to be alternative assets that you can add to your multifamily portfolio. So we're going to be going into a deep dive on, what are like kind of the top three assets that do really well in a strong economy and that do really well in a down economy. And then we're going to talk about kind of how can you gauge the level of interest of your investors to see whether or not adding one of these three things might be palatable for them. And then, of course, we're going to be talking about how you can strategically add these to your portfolio, whether it be passive or active side. And of course, we'll be talking about a few other things in the midst of all of this. And for those of you who have joined us live, would love to be able to answer any of your questions that we have live on here as well. So let's go ahead and first talk about the two events that we have coming up. We have the Multifamily Investor Nation Summit coming up in June 2021. It's actually going to be June 10th, 11th, and 12th of 2021. So if you want more information about that, you can go to mfinsummit.com to be able to find more details about that and to go ahead and register. You can also go to Storage Investor Nation. So you just go to storagesummit.com. So the reason why I mentioned this today is because obviously this is our multifamily series, but today we're talking about these alternative assets. So I'm trying to give you a little bit of a hint here as to what one of those alternative assets are going to be. And one of them, of course, is self-storage. So you can go to storagesummit.com and register for the next summit that's coming up. And it's actually coming up next month. So this is March. This is actually going to be April 15th, 16th, and 17th of 2021. And then we already have another one scheduled for the fall in October. I don't exactly have those dates, but they'll be released at the summit coming up in April. So if for some reason you missed this one, you can join us on our next one. We try to do these twice a year. So without further ado, let's go ahead and dive in. I'm Dan Handford, the founder of the Multifamily Investor Nation, as well as your host today. And you can find more information about me. I'm one of the managing partners of a group called PassiveInvesting.com. So you can actually just go to PassiveInvesting.com if you want to find out more information about me. I'm actually on there on the Meet the Team page as one of the managing partners. Have a nice video there, so we don't take too much time here today going over that information. So let's go ahead and talk about these three things. And so for those of you who are live, I want you to get your chat box ready because I want to see if you can guess what the top three assets are that do really well in a strong as well as a down economy. So go ahead and type in the chat box right now and let me know which one you think it is. Which one do you think is the most popular when it comes to these three assets? So in the chat box, let me know just randomly. Of course, I already told you one of them and you probably already know another one. So let's do this. So obviously we talked about multifamily, right? So this is the Multifamily Investor Nation. So that's definitely one of the top three assets. Number two is self-storage. But what's that third one? What's that third one that you might think is a top one as it relates to the kind of a top asset or alternative asset, if you will? So a lot of you on here are saying mobile homes or mobile home parks. And I still lump mobile homes inside of multifamily because it's still multifamily, right? Because you're going to buy a park that has multiple family units on it. So typically I kind of lump those under the multifamily kind of umbrella. So if mobile homes are not in the picture, what would you say is that next asset? And I will tell you that this is kind of a trick question. So maybe that'll give you a little bit of a hint. So there's three things. Let's not even call them assets. There's three things. Somebody said Bitcoin. There's three things that do really well in a down economy and three things that do really well in a good economy. So somebody on here, Dan, actually hit the nail on the head. It's actually alcohol. So we have self-storage does really well because people, when they're in a good economy, they're buying a lot of stuff and they need a place to store their stuff because they run out of space. And of course, in a down economy, they're trying to downsize. So they need a place to store their stuff because they're downsizing, right? And so storage does well in kind of both sides of the economy. Same thing with multifamily, right? Multifamily does really well on both sides because even in a downward economy, guess what? People still need a place to have that they call home, right? They still need this roof over their head. And so it's a very stable asset class in multiple types of economic recessions or economic booms. And then of course, you can kind of think about that the same way, right? As far as alcohol is concerned, kind of a little bit of a joke, but and we're not going to really be talking too much about trying to add alcohol to your portfolio, but there's obviously other ways to do that if you wanted to, like, buy into a liquor store or start your own liquor store or go into acquisitions mode or something like that. I don't personally invest inside of alcohol stores or alcohol in general, but I do know a lot of other people that do have that in their portfolio because of the recession resistance to it. Now, somebody in here mentioned hotels, and I would say if you knew anything about what happened in 2020 during the recession, hotels did not do so well, right? They were actually, I have know somebody personally that is in hotel management, and they got hurt and got a beating really, really bad. And usually when you have a retraction in the economy, you have a retraction or a decrease inside of the occupancy rates inside of the hotel industry. So it's not necessarily very recession resistant, although I do like kind of the hotel asset class. It's just a different level of risk. It's a different risk profile. And right now you could probably get some pretty good prices and some pretty good deals on some of these hotels, especially the boutique hotels that aren't associated with some of the larger chains, and get some good pricing there. And I actually know somebody who is trying to buy hotels and convert them to studio apartments so that they are now actually converted to a true multifamily asset instead of the other. So, and Charles says, now the SIN acronym makes sense. So the SIN acronym is actually Storage Investor Nation. We were kind of going back and forth when we were starting the Storage Investor Nation and trying to decide whether or not it was actually going to be a good thing to call it the SIN Summit. Like the coming up event is going to be the SIN Summit. But we are obviously we thought it would be better than MFN, right? So MFIN Summit, right? So the MFN Summit. So you can kind of look at it both ways, to kind of see which one would have been better. But yes, you are correct, Charles. It is actually called the Storage Investor Nation. All right. So let's talk about, how do you gauge your investors? How are you going to gauge your investors on this type of an asset? So one of the best ways to be able to gauge the level of interest in your investors is to have a relationship with your investors. Now you might think that that's kind of, well, that makes a lot of sense, right? To be able to know what they want, you got to have a relationship with them. And so that goes back to some of the other webinars that we've done on building out your investor relations team to make sure that you can actually have a relationship with your investors. You want to make sure that you are not just they are not just a number to you, but that you actually have that relationship with them. And there's multiple ways to create that relationship, and that we're not going to go into this detailed analysis on the webinar here, but you can go to our YouTube channel. You can find some additional videos that we've done on investor management, investor relations, raising capital, where we go into a lot of detail in regards to how to build those relationships with your investors. One of the things that you can also do, in addition to kind of doing some of the things that we do to build relationships, is you can survey your investors. Right? There are software companies out there that they have built out platforms that all they're designed to do is to survey people, and it can be anonymous so that your investors aren't feeling like, you're kind of, pointing a finger at them. And so being able to have those surveys are beneficial to you. So I'm on several different people's email lists when it comes to either multifamily or self-storage, and I get these surveys all the time. Now, I don't think I've ever filled one out, which is kind of another kind of problem that you might have, is you might only get a 10 to 15% response from those investors, but at least it gives you some data, right? So that's why I always say the relationship side of things is actually going to be a better way for you to be able to find more information from your investors, is to gauge their level of interest. And then one of the things you can also do is go ahead and get a deal under contract. So at passiveinvesting.com, one of the things that we did is we actually brought on a self-storage team to be able to work under passiveinvesting.com with us very closely and directly. And we put together our very first deal together as a team. And it was a kind of a smaller deal. So, right now, we're working on some pretty large deals. We have a deal right now under contract in the multifamily space out of Orlando, Florida. And it's actually a $55.231 million acquisition price. And we're raising almost $18 million. I think it's like $17.9 million from our investors to acquire that. And if you're interested and you want to join us on that property, you can certainly go to our website, passiveinvesting.com. Fill out the investor form there. We'll jump on a phone call with you, discuss your investment goals, and see if our group is the right fit for you. But we're almost full on that one. I think the last time I checked, we were probably close to about 90-95% full as far as that acquisition is concerned. But when it came to the self-storage side of things, we wanted to get kind of our first deal under our belt. So we found a really good deal, had really good return metrics to it. Even though it was kind of a smaller deal, it was only about a little over a $1.8 million purchase price. And we were adding on another level, another kind of facility on top of it, which was going to create another value add bump for us. And so overall, we were actually raising $1.7 million on that particular property. And that 1.7 million, when we released it to our investors, we actually filled that up in 45 minutes. And then shortly thereafter, we had over 8 million in oversubscription on that property. So that right there was a great test for us to know that our investors are interested in self-storage and they have an appetite for it. And there's a lot of demand for it. Now, I will also tell you that we also increased the minimum investment on our offerings as well. So we used to have a minimum investment of $50,000, and now our minimum investment is $100,000. So obviously, when you increase your minimum investment, you will also have the ability to raise more capital for your deals too. So keep that in mind as you're structuring things. And maybe as you get started, start off with the $50,000 minimum, and then as you kind of get going and you build that track record and you build that credibility, you can be able to raise more capital by increasing that minimum investment to $100,000. And I even know some people that the minimum investment is actually, close to about $250,000 or more. I even know one that's $500,000. So it just depends on what kind of investors you have, right? So if we went out there and said the minimum investment was $500,000, we probably wouldn't get very many people to invest, right? Because most of our investors are around that $100,000 mark. Even when we had it at $50,000, the minimum, not the minimum, but the kind of average was around that $100,000 mark. So it actually fit really well with our investor profile when it came to the actual investment minimum. So that's one way, is to get an asset, get it under contract, and then, of course, release it to your investors and see what kind of appetite you had. Now, we started on purpose with a smaller one because we wanted to kind of gauge that appetite, gauge that interest. And now we're looking at even larger portfolio deals within self-storage, which will allow us to acquire, $30, $40, $50 million assets that have our portfolios that have multiple assets in one particular portfolio. It also creates a diversification for our investors as well, because we might have 3 to 5, maybe 7 assets inside of that one portfolio, which helps to provide some diversification when it comes to the risk profile as well. Now, how can you strategically, I kind of already answered this one, how can you strategically add this to your portfolio? That's really kind of how you do it, right? You can, gauge the level of interest with your investors, and then the way you strategically do it is you kind of bring that self-storage team on. So one of the things that we did in our thought process is that we could go out and we can learn self-storage. We could do it all of ourselves, take our focus away from multifamily, but then guess what? It's going to reduce our acquisitions on the multifamily side, and we didn't want to do that. And so what we decided to do is go find an operator that already had a track record in the background inside of the self-storage space. And we leveraged their experience and their credibility and said, we worked out a deal with them where they can be brought underneath the passiveinvesting.com brand. And now they are our passiveinvesting.com brand when it comes to self-storage. They are actually our self-storage team, and they've run that whole piece for us. Okay. Now we're still in the background. We're still, and I wouldn't even say the background. We're still kind of there in the forefront, managing the investors, managing the investment, doing the asset management, processing everything from the back-end administration side of things. So for that operator, it was a win-win because they can now close more deals. And then it also was a win for us because we have investors that have the appetite. And so we just joined forces together and said, let's make this thing even bigger. And so as we move forward into 2021, one of the things that we're going to be looking at is we're going to be looking at adding some additional asset classes. So we might not move into it as fast as we do with self-storage, but we're looking into some other assets, right? We're looking into, say, maybe the industrial space and the warehouse space, even the medical office building space as well. And then maybe even venturing into kind of the alternative business plays of building that has real estate associated with it, like car washes, right? Acquiring portfolios of car washes, and then eventually getting into the development side of that. But again, we don't want to take our focus away from multifamily. So we will be looking for a team to be able to bring on that can actually manage that aspect for us. So let me go ahead and open the chat box up here for any questions that you may have, so we can spend some time here answering some questions. I have probably about another 5 to 10 minutes that we can spend here answering some questions. And if you don't have any questions, obviously that's great, because that means I answered everything within the content and there's no additional questions, right? But if you have some questions for me, I would love to be able to take some time here to spend with you and answer some of these questions as we move forward and move down the road. And if we go through and we don't have very many questions, that's okay. We will be here every single week. And next week, we have another topic that's coming about. Let me see what this next topic is for next week. Let me see if I can get this thing up here. 1 second. Doesn't look like it's updated just yet, so I'll give it just a minute here. The actual it says, what's your question coming in here from Ryan? What's your target IRR with alternative assets? So it's very similar to what it is with multifamily, right? So I don't want to go outside into some alternative assets and then get a lower return, right? And so typically what we do is we have a target IRR dependent upon the asset class. So if it's a higher end asset, kind of a class A, we're going to be looking for that kind of, 11, 12, 13% IRR range on a 5-year hold. And then if we're looking at some of the B plus with value adds, it could be a little bit more than that. So it's going to be more like, 13, 14, 15%. Now, years ago, it was a little bit higher than that, right? But as the market has tightened up, we've had to adjust those numbers based on the market and the market conditions. And so our investors are aware of those numbers and aware of those ranges. And that's kind of what we try to do. If we can't find an asset that fits in that range, then it's just not, it's a no-go for us, right? Because we know that there's assets out there that can fit that range. We just have to spend enough time finding those kind of diamonds in the rough. All right. So the next question here is how do we get on the mailing list for alternative investment deals? So the easiest way to do that is just to go to our website, passiveinvesting.com. And in the top right-hand corner of the screen, there's a button that says Join the Passive Investor Club. When you click on that button, there'll be a form that you'll fill out. When you fill that form out, you'll be one of our team members will reach out to you to schedule a phone call with you to discuss your investment goals, to make sure that we're the right fit for you first, right? And then once you're on that list and you go through that phone call process, then we will start to send you some of the deal flow that we have on some of our assets. Excuse me. Another question coming in here is, what are your thoughts on ATM syndications as an alternative? So this is a great question, Dave, and I'm kind of glad you brought it up, but then I'm kind of not glad you brought it up. But as far as ATMs are concerned, the biggest problem that I see with ATMs is that they basically depreciate to zero at the end of the day. And some people might not mind that and are fine with that. But I also see that there's a lot of, I don't know, it's probably more my mindset and my headspace on this more than anything else, because I don't really use the ATM that much. And if I do, I usually go to a bank. I don't usually stop at a gas station and get it. And also, my bank actually reimburses me for all my ATM fees, because I have a local bank that doesn't have a huge, platform or whatever of ATMs. But according to some of the numbers that I've seen, they can produce some pretty significant cash flows. So if you invest inside of an ATM in the ATM syndication space, you want to make sure you have the ability to reinvest that cash as soon as possible. That's how you will kind of create that, kind of faux compounding effect with your investment. So as long as you have that available and you have that in place, then I think it could be a good asset to be able to invest in. But I myself personally have not invested in it yet, mostly from the tax side of things, because of how it actually depreciates down to zero. And at the end of the day, those assets are still being sold somewhere. I don't think they're just going to get to the point of where the asset is worth zero. And so some of the syndications that I've seen, I'm like, I don't really understand how in like 7 to 10 years it goes from a valuable asset to just zero, and then somebody else gets it instead of me, right? So I don't know. There's still been some unknowns and some questions there. From an active participant standpoint, there's actually a higher barrier of entry to get into that space than there is with, like, say, multifamily or self-storage. Because I've actually investigated that myself as well, to how we could actually just go and acquire kind of routes for ATMs, but then you got like staffing, you have cash issues and things like that. So there's definitely some additional hurdles that come into place when it comes to those ATM businesses. How long do you plan on keeping the storage units before selling? So the plan for those is going to depend on the asset, right? So typically your kind of B plus with value add is going to be very similar to your B plus with value add in multifamily. There's a lot of, similarities between the two. It's going to be about a 5-year hold. If we're going to go after kind of an A class asset, so we call it suburban class A's and multifamily, but similarly inside of a self storage, kind of an outside of the urban core type of self storage asset, we're going to be looking at probably like a 5 to 7 year hold, right? And those are all based on how we base our projections, but a lot of it just depends on the debt and the terms and various things like that. So every deal might be just a little bit differently, but usually it's going to be between that 5 to 7 section. Let's see. Will you be considering working on development projects in the future, either infield or greenfield? So we are in the process of doing some due diligence and investigating new development projects, whether it be multifamily or self-storage or other asset classes, but we have not pulled the trigger on it just yet. Mostly because it's actually one of the highest risk categories to invest in, but it also provides some of the highest returns, which is great that it provides the highest returns. But again, there's that risk profile that's there as well. That's one of the highest risks. And so we want to make sure we definitely tread and go slowly in that space before we actually pull the trigger and go forward with somebody. We got to make sure that we have the right partner in place in order to do that. All right. So that's all the questions that I have that have come in. There's actually one here. There's one more question here. How long do you spend stabilizing each new asset before adding on another one? So I think in the beginning, Jerry, it was a little bit more challenging because we had that first deal that we got, right? And we wanted to make sure we could perform on that one and prove it to our investors before we brought on to the next one, right? Want to make sure we could provide those returns. And so it really depends on where you are as far as credibility. So like right now, we're closing on that large $55.231 million deal at the end of April, first part of May. And we will likely already have another deal or maybe 2 deals ready to present to our investors between now and then. And so we'll have multiple projects that we're doing all at the same time. But we also have our team built out where we have an operations team that manages all the asset management and can oversee the takeover process. And so we're not having to take away our acquisitions team to focus on that, where our acquisitions team, that's what their goal, that's what they're spending their time on is acquisitions, right? Acquisitions. And of course, on our investor relations team, we're focused on trying to attract new investors into the fold, right? Because in order for us to acquire more and more assets, we have to continue to find more investors. And then our asset management team handles the takeover process. So we can acquire multiple properties now at the same time. But in the beginning, I think the first year to 2 years, we acquired one asset, waited a few months, acquired the next asset. Once we worked those systems out, we did the same thing, work the systems out, and then acquired the next one and the next one. So, but our goal right now is to put together anywhere between about 4 to 5 on the low end and upwards to about 7 or 8 deals every single year, and in both the kind of self-storage space as well as in the multifamily side. So let me go ahead and see what the next topic is for next month. Next week, excuse me. Let me see if I can refresh my screen here. See if I can get a little update. All right. So it brought me to the mfinsummit.com page. So let me go back to the MFIN webinar page here and get an update for you so you can kind of see what's going to be talked about next week. And it looks like I might have had a few more questions come in. So I'll take 1 or 2 more questions before we go as well. So next week, we're going to be talking about we're going to be talking about what to do after you've signed your PSA, right? So the topic of the title is you've signed a PSA, you've signed that purchase and sale agreement. Now what? Right. And this is going to be kind of part 1 of a 2-part series that one of our other managing partners, Brandon Abbott, who's on our acquisitions team, is going to be kind of going through. He's going to be talking about the property condition assessment, real property due diligence, phase 1 title survey, whether you should walk every unit or just a certain percentage of them. Should you check every one of the leases? And then what does retrading a deal mean? And should you do it? And when should you do it? If you should do it? And of course, he'll be adding a lot more of color inside of that as well. So the couple of questions that came in here on It says, what are your thoughts on investing in mineral rights? So I have no experience and background in mineral rights, so I cannot answer that question. But I do know Vanessa Peters has talked about that in the past, and she also mentioned it at the last summit, like you mentioned there. But I have not done any investigating on that, so I can't opine on that at this time. All right, there's one more question in here. Let me see if I can show this one as being answered. How does the return compare for development versus typical Class A or value add Class B? Well, I mean, it really depends on the type of development that you're doing, but Class A, I mean, is totally different than development. Right. And the reason why I say that is you could do a Class A development, but a Class A development, the return metrics are totally different than a Class A purchase. So when we're purchasing this Class A deal out of Orlando, Florida, we're getting sub 15% returns on this, right? Where the developer on this is probably getting, 20, 25, maybe 30% returns. So the returns for them are a whole lot higher because they're the ones that actually built and developed the property. They've stabilized it, leased it up, and now they have this property that they can actually sell. But the risk there is the time that it takes to hold on to your capital for 2 or 3 years while it's being built up, and then the risk of will it actually lease up once we get it ready and for vacant for occupancy, right? There's a lot of different nuances when it comes to development, and that's why the returns can be so much greater. Now I've looked at some new development kind of syndication deals, and the returns are actually comparable to what we're seeing right now. They might be a little higher. They might be between like 15 to 20%. But I look at that and go, for me as an investor, a new development deal would have to be above 20% for me to even look at it, because if what's happening when it gets to that point, a new development deal being below that 20% mark, the operator themselves or the developer themselves are taking too big of a cut. And they look at it and go, it's because we can, right? But for me, I want to make sure that when we're looking at new development deal, from a passive perspective, I'm looking at these new development deals, I want to see that return being above 20% if I can, depending on the asset class, depending on the location, the market, and things like that. But if I'm going to have my capital tied up for a pretty significant amount of time and getting no cash flow during the hold period, then of course it changes the return metrics, because our group at passiveinvesting.com does monthly distributions. So what that allows our investors to do, if they can get this in place, is to reinvest their money every single month as they're getting their distributions. And now they kind of have that compounding effect. And one of the other things that our group has is we actually have a real estate debt fund that provides a 6% compounded return with a 90-day liquidity option, which means at any point in time during their investment, if they want to get their money out of it, in that real estate debt fund, they give us a notice, and within 90 days, we can liquidate their funds out of there. So what that does for the investors is it allows them to be able to take their monthly distributions off of the assets, and they can roll it straight into this real estate debt fund and now compound their monthly returns by 6%. So now they're creating this snowball effect. And then when we have our next deal to present, if they want to pull some of that money out, they can pull that out and then of course invest it inside of that next asset. So there's a lot of different options there. And if you're interested in that real estate debt fund, we actually have some information about it on our website. You can go to passiveinvesting.com, and under the offerings tab, there should be a drop down there for real estate debt fund. You can find out more information about the real estate debt fund there as well. I want to thank each one of you for being here this week for this particular series, this particular edition of the series on multifamily investing. And if you have further questions for us, make sure you save them for us and send them to us next week. If you want to connect with me further, you can connect with me on LinkedIn. Just go to linkwithdan.com, linkwithdan.com, and you can join me on LinkedIn. And that'll basically just bring you straight to my LinkedIn profile page. You can find out more information about me, but also go ahead and connect with me further on LinkedIn. And look forward to seeing you here next week with the next topic around what to do after the PSA.